When investing in a company, one key thing to check out for is how much debt the company holds. Because just like people, too much debt can break a business and ruin your investment. So in this video, we're going to break down what stock debt means and how it affects you as an investor. Now, remember, this is not a financial advice. Always make your own personal research. Let's go. Stock debt is the money a company borrows to finance their operation, growth, or investment. It could be in form of bank loans or bonds issued to investors. You know, like when you invest in a bond where you tell the company, I'm going to give you this money for 3 years, and the company will say, for each year we are holding your money, we are going to give you a particular interest. So that's bonds issued to investors. And then also credit line. Debt isn't always a bad thing. If a company doesn't manage it well, that's when it becomes a bad thing, because debt is actually a tool that you can use to grow your company or even the investments for the company. So now there are different types of debts. We have the short-term debts and the long-term debts. So short-term debts are usually like within 12 months. Maybe they want to use it temporarily for working capital or temporary needs. And then we have the long-term debts, usually for business expansion or large purchases. So why does it matter to you as an investor to know a company's debt? One is leverage. Debt can help a company grow faster by funding new projects. So the next one is ownership protection. So unlike equity, debt doesn't dilute shareholder ownership. Just that with debt comes some risk as well. Like one, high interest can eat up into a company's profit. So say for example, a company goes and borrows a lot of money, and then the interest rate that is given to that company is extremely high, that even the profits they are making, the debt is eating into that profit. Is very risky. The next one too is default risk. So when a company defaults in their payment or fails to pay back whatever loan they've taken, the company can actually file bankruptcy. And when they file bankruptcy, it will affect you as an investor. Next is that it could be a red flag. Not all the time. Remember that I said that debt can be a good tool to expand. But when a company is borrowing so much money and the money is not for expansion, the money is to survive, then it's a bit tricky, because that is very risky. So how can you check a company's debt? It's very easy. You can always go to Yahoo Finance, search the company, go to the statistics tab. You will see every information you need about financials. You will see the debt that the company is owing, and that will help you make some financial decisions when it comes to investing in a particular company. So it's always good to know if this company is borrowing this money to grow or to survive. Remember that debt is a tool. It's not always a bad thing if managed properly. I hope this video helps, and I'll see you in a minute.